Hello, everyone, and welcome to Webinar Wednesday. I hope you have all had a good, albeit short week. Hopefully you all enjoyed a long weekend with Labor Day. We have the distinguished Dr. Charlie Martinez joining us again. It's always enjoyable to hear from him on all things econ. And today he is going to be covering different dairy risk management strategies. So that would include things like dairy margin coverage, dairy RP, which does that just stand for risk protection?
Revenue protection.
Revenue protection. See, this is why he gives the talks and I don't. And then LGM dairy. Any other ones or just those main three?
Those three.
All right. So it is officially 12 o'clock. I'll keep monitoring the thing to let people in. Just as a reminder, if any of you need credit for Master Dairy for watching this webinar, please fill out the post watch survey. I just sent it to you now in the chat. That is the only way I know how to count you, since some people are listed as iPhones or phones or just calling with a phone number, and I am many things, but clairvoyant is not one of them. So please fill out that survey to check in for class today. And also tell Charlie and I how we're doing. So what other things do you want to learn about? What did you like? What did you not? Yeah, so without further ado, Charlie, take it away.
Thanks, Liz. I don't know how distinguished I am. If Bilderbeck was on, he would say it's very much the opposite, probably. But I'm Charlie. Nice to be with y'all again for this program. Today, we're going to cover the dairy risk management strategies, and it's broadly titled dairy risk management, but more specifically tools that are associated with dairy risk management. And so I'll give you a little bit, if I can get my computer to work here. There we go. I'll give you a little overview so what you can expect, kind of how the flow of the presentation is going to go. First, I'm going to talk about some of the Dairy Outlook comments from last month's report. And that kind of sets the stage for the risk management. And then that we'll go into some tools. And then at the end, if there's any questions, we'll have some, or we can take those. If I do a good job and if we do risk management and it's confusing, then that means it's a good job and we'll have questions. So real quick, out of last month's Dairy Outlook notes, something that stuck out to me was the all milk price forecast for 2022 was lowered to $17.85 per hundredweight, which is 65 cents lower than the previous month's forecast, as relatively low prices and high stock levels in 2021 are expected to carry forward into 2022. And so I took this exact thing from their calculations, and as you can tell, if we start looking at all class 3 in all milk, not only did they lower it, but we're trending still down. Like prices are still trending downwards. And so we start thinking about the future and kind of doing some risk management for the upcoming 2022 year. What can we do, and how can us as dairy folks, how can we adapt to that and try to not allow it to hinder us in any which way? So if we think about prices, they're trending down. I'm very excited to see what happens in this month's report, to see if they continue to lower it some more, because that'll give us some insight. And so if we start looking at also at feed costs, and thanks to Dr. Aaron Smith in our department for pulling this together for me, not necessarily exactly the price that's used in the formulas that are used in the programs, but what I wanted to highlight is kind of the peak of prices, the trend of prices. And so not only do we have an estimated price point that's trending downwards, but we still have high elevated feed costs out there. So that presents some issues for us in terms of smaller profit margin, probably in the not so distant future. And then also along those same lines, not only is the profit margin kind of looking like we need to do some risk management, but each operation is also going to have its own challenges in terms of profitability. Working with David Bilderbeck on the dairy gauge front for this past year, margins were already tight if we were to take out government payments. And so without government payments and the government programs, it would put some dairies in a not so good situation. And so the point of this conversation and the point of this presentation is to really highlight the need to continue risk management. And if you're not doing risk management, hopefully encourage you to at least do one of the programs, if not multiple programs that I'm going to show you today. And so I think not only is the price and the profit margin looking kind of small in the not so distant future, if we think back to 2020, it showed us that many things can happen and stuff that's unforeseen can happen, and that's the risk that's associated with the unknowns that are in the future. And so that showed us that risk management is critical. And so today we're going to cover again the DMC, the LGM dairy, and the dairy RP. So dairy margin coverage, livestock gross margin dairy, and the dairy revenue protection programs. And so first, some people probably do use this, and we'll get into it here in a little bit, that a lot of people do use dairy margin coverage, but I still wanted to highlight the program, kind of the background of it, because I do feel from a risk management strategy, this is the first line of defense and probably the one that we encourage producers to utilize at least whenever they start thinking about their risk management strategy. So again, dairy margin coverage, it was authorized in the 2018 Farm Bill. It replaced the margin protection program for dairy. If some people still haven't used DMC and they're wondering what is it like, it's, it replaced the MPP dairy, and it continues to offer protection to dairy producers when the difference between the all milk price and the average feed price, which is the margin, falls below a certain dollar amount selected by the producer. And so I had all this is on here in a lot of words because I'm gonna send it to Liz in case y'all wanted more explicit definitions about how stuff works. But the details of it is that the coverage is available for margins from $4 to $9.50 under the tier 1, or it could be $4 to $8 on the tier 2 and 50-cent increments. Producers will select their coverage triggers at or above the 450 level, must pay a per hundredweight premium ranging from that 0.0025 to $1.83 per hundredweight of the milk that's enrolled, depending on the tier and the trigger rate that the producer selected. All enrolled producers must pay a $100 administration fee, and we'll get into how sometimes that is waived. And then also producers who select $4 coverage as their trigger point, at or below that, don't have to pay the premium. And then the production history selection ranges from 5 to 95% in 5% increments of a producer's established production history. And I say that because as we move forward, we start thinking about what happened last year. There were some amendments to this, and under the 2018 Farm Bill, the production history was based on the 2018 Farm Bill of the highest operation of the markings from 2011, 2012, 2013. That obviously is not, that's almost 10 years ago now, or it was 10 years ago in terms of that production history. And so under this framework, production history from the operation would not have changed even if the farm characteristics such as size had changed since then. But in December of 2020, the Consolidated Appropriations Act of 2020, it allowed for supplemental DMC or supplemental income based on production history. And all that basically means is that it was 75% of the difference between the 2019 marketings and the old calculation. Remember the 2011 to 2013 milk marketing number. And so it allowed for if your herd increased in size, it allowed you to adjust for that. While the new policy allows operations to opt in for higher production coverage, if it does change, currently right now, there's still no guidance from USDA how those details are going to move forward with the new farm or the extension of the current Farm Bill as we're still waiting. If we extend it, how long is the extension going to last? Stuff of that nature, because it's attached. This specifically is attached to the Farm Bill, and so that's something to kind of keep an eye on. I would anticipate something happening soon in terms of guidance from USDA. And so we're going to get straight into it. If we know, I just talked about it in detail, and so let's actually put it into practice and kind of what is relative margin. So the DMC margin is the milk price minus the estimated feed cost per hundredweight of milk. This offers the opportunity to establish a margin. I put that an asterisk and highlighted it, margin level. And so again, it's the milk price used, the all U.S. milk or U.S. all milk price, so get tongue tied here, is the price that's used. And it takes the average feed cost calculation that is the sum of corn, soybean meal, and alfalfa. And so how you can look at it as a producer is that you can ensure the margin at $4 to $9.50 per hundredweight. And so it's going to be flexible in terms of what margin you want to cover and how much of that margin you want to cover. And again, that's going to be dependent upon the size of the operation and also what trigger point you pick. And so the question is then, what is the ration that DMC uses, and how is that price formulated? And so the DMC uses the national corn and alfalfa hay prices in order to come up with the corn and alfalfa component. And then for the soybean meal component, it's used from the rail price out of Decatur, Illinois, And I'll show you here the next calculation. I used their calculation from the actual price from yesterday. And the quantities that are assumed with that is 60.1 pounds of corn, 14.7 pounds of soybean meal, and 27.4 pounds of alfalfa hay. That is fixed. We cannot adjust that. The program is defaulted to that. And so we can't really change that. And so what matters more is the price. The change in prices is what's going to affect the trigger point, but also kind of what we think in the future, what our margins are going to look like. And so if we think about it, if we just think back a long time ago in the August 2014 margin, the margin calculation probably looks something like this, where US milk was 23.70, corn was at 3.70, soybean was at 4.32, and alfalfa was at 2.09. We take our weights there that are associated with each component within the ration, and we end up with an actual margin of 13.69. Obviously, that's fine, and it wouldn't trigger a payment. But this past summer, it probably looked more like this, where US milk is 17.90, corn is at 5.24, soybean is at 336.80, and alfalfa is at 2.30, which gives us an actual margin of 6.30, which would trigger the trigger point of DMC below that 950 threshold. And I think we're on our 7th straight month of trigger from the DMC program. And so, as the prices of the feed costs have gone up and US milk really hasn't responded in the positive direction, it really has given our producers a floor to protect themselves with, which shows that the program is working. And so what I wanted to highlight is when I talk about prices and what moves everything, because we have a set ration, I put up here, if you see the factor or the component, we have all milk price, corn, soybean meal, and alfalfa hay. And I put again, these prices that you saw right here, I put it here and we said, okay, we're going to hold those prices constant, and we're going to look at a 10% change and see what would happen. And as we take the calculation and we use the weights that are associated with the components, you can see that all milk for a 10% change was $1.79 change in the margin. Corn accounts for 60 cents. Alfalfa hay is the next highest one at 32 cents, and soybean meal follows up with 25 cents change. And so with that, what I want to highlight before I go on, I'm going to highlight this real quick, that change in price is really critical month by month for our producers. And it's why it's critical while the margin or the ration's fixed, these prices still can impact and provide our dairy producers with some protection. And so it's okay, Charlie, that's cool. But what happens, when is the payment made? If we know the calculation, all that's cool, but when is the payment made? The producers will select the $4 to $9.50 coverage level in 50-cent increments. The payment is made any month when DMC margin is below the coverage level. And then think about it at 1 month worth of production. And so 1 month is 1/12 of production. So payment is made on a 1/12 of covered milk. And so again, just want to think about it as 1 month worth of production. Okay, so if we know how it's triggered, how many pounds can I cover? So it's going to be based on your production history, the highest annual level of milk marketing from 2011 to 2013. Again, remember last year there was a little bit of leeway for the increase of production. And I put possibly because in the new farm bill, if we have more adjustments to the farm bill, it's possible that they could adjust it to where they could move the date ranges. There's certain things that I've heard from the Hill that they might move it. I won't say explicitly just because it's coming from DC, and sometimes those things are fluid and don't really want to put a fact out there that turns out not to be a fact. Producers can cover up 95% of their production history. And so a simple example, if we had 150 cows and we had a rolling herd average of 21,000 pounds, if we do 150 times 21,053, that gives us 3.58 million pounds of production history. And we say, hey, that's our highest, let's grab that one. And we can cover up to 3 million pounds. And why is 3 million pounds used? Remember, we can cover up to 95% of the production history. So I say, well, let's just cover it all. And so we can cover 3 million pounds. So that's the amount of pounds that someone could cover, for an example. Of course, if you have more cows, that adjusts the amount of production. And then also, as you remember those tiers, you start moving tier 1 to tier 2, the more production you have, and the more the millions. If you go over 5 million pounds, you can go into tier 2. Just kind of a quick rule of thumb. And so this I kind of lean on this sometimes, just thinking of averages in terms of a quick synopsis of how many pounds you can roughly estimate if you didn't know exact number, if you just want to round it in order for a projection. Again, I'm going to give these slides to Liz, so that way if you just wanted a quick dirty calculation on the amount, you could use this if you were still kind of guessing a little bit. And so, okay, Charlie, we know how it's triggered, we know how many pounds we can insure, and we know our production history, but what's the cost to it? As I mentioned earlier, there's a $100 annual administration fee, and sometimes these can be waived for beginning, veteran, or limited resource farmers by the definition of that part from them. But you can also, it buys $4 margin coverage. It's the same regardless of size, and there's an additional premium for higher coverage. And premiums are paid on each $100 or 100 weight covered, so from 5% to 95%. So remember, on the last example, I covered 95%. If I covered 5, it'd be a different premium associated with my 95. Coverage level and coverage percentage are chosen each year, 25% discount to make up a one-time selection. I have here, what I want to mention is, if you haven't been in DMC and you're thinking about enrolling, there is the option to do a full coverage up through 2023, and you could get a 25% discount once if you were to lock it in through 2023. I don't know too many people that have taken advantage of that, just because whenever this program was reintroduced in 2019, some folks were still wondering if it was going to trigger and was it worth the cost in order to be insured or be in the program. And so along that same line, is kind of looks like a messy slide, but I'll walk you right through it. If we know, the next question is, okay, how many times does this thing trigger? And because that's going to essentially answer the question, is it still worth, or is it worth the cost? Is it worth the risk management component of it? So if I'm paying for something, does it give me protection? And so I went and pulled this actually from the DMC website or the decision tool, and I just said, what's the last 31 months look like? And out of the 31 months, the number of months where the payout was 19 months. So almost 2/3 of the time is there a payout. And you can see the average premium and all of that stuff. Didn't really want to mention, I mean, that's going to be adjusted depending upon coverage level and everything of that nature. But what I wanted to really highlight was that basically 2/3 of the time, the past 31 months, there's been a payment. And then what I also wanted to highlight, and I mentioned earlier in the program, that most of the producers here in Tennessee do participate or utilize DMC. If you go to the DMC data and you look up participation rate right now, it would say, I think we're 55% or something, about, nowhere near what I have calculated here. And the reason why that's different is because the number of farms that were used or estimated for Tennessee was based on the census of the last census. And they had us at 250, I believe the number was. So if we have, half of that, or 130 of them, for instance, for 138, it's going to have us at a low percentage. But in reality, if we think about it, and we know that over time we've lost some dairies in our state, we're roughly at 160 now since 2018. And so using that same calculation, I utilized for 2019. I went ahead and said, okay, if it was 2018, what was the number that come from the census, then let's go ahead and use that number. So there was 181 operations that utilized DMC in 2019, and if you utilize a 250 number, that puts us at 82% participation rate. But since I've gotten here, I've seen we're here in 2020 and 2021, we've lost more producers, and we're roughly at 165. So I just went ahead and utilized 165 for the past 2 years. And keep in mind, this is more of an approximation, but in 2020, there were 122 operations that utilized DMC. If we say, okay, there's 165, that's 74% participation rate. That was a trend that kind of held true nationally for last year. There were some folks that didn't enroll in 2020 compared to the previous year, and we saw that here. So in Tennessee, we kept on trend with the nation. But in 2021, we bumped up to 138, which puts us at 84%. And so what I want to highlight, and kind of, it's more of a tip of the hat to the producers of Tennessee. We've gone from 82% in 19, we went down to 74%. And I think a lot of people realize the uncertainty that can happen without a moment's notice, and said, hey, I'm open, we're opened up to too much risk. We need to adjust and prepare for it, or at least acknowledge that it's possible. And 84% of people bumped back up and said, we need to get DMC, and we increased our numbers here. in 2021. You can see the total payout was a little bit more, and that's a function of some of the extra supplemental money that came in from the COVID relief and stuff of that nature. And as you can see, the payment per operation was way higher in 2021 compared to 2020 and 2019. So again, I say we've talked about DMC, and there's majority of everyone uses DMC, but for the folks that don't use DMC, hopefully, maybe this can be a program that can really help you moving forward, especially with the uncertainty of how things can flip right now and how things are very fluid in terms of openings and closings and stuff of that nature. So then I think we think of DMC, and I think of it as being the base level of risk protection. If not, it's the first defense line of risk protection. And so now we're going to get into two other programs. The next one can get a little, it's going to be different, and the protection depends upon the operation. It has a lot of flexibility, and that program is known as livestock gross margin. Just from here on out, we'll call it LGM dairy. So it's livestock gross margin dairy, but I'll call it LGM dairy just for one sake of typing it out on my slides, but also most people know it as LGM. So this is also a margin similar to DMC. We're trying to protect the margin, but this is more of an insurance program, which is available through insurance agents. And so if you do like crop insurance, you probably are more familiar with that. It's kind of similar to that in nature. DMC is offered by FSA, so kind of keep in mind, the who sells the insurance program is, your insurance agents. DMC is from FSA. But this goal does not change. It's still to lock in that margin that we talked about. We want to protect that margin. Producers want to protect that margin. But there's two differences between the program. One is feed cost. LGM utilizes the corn and soybean futures in order to estimate their cost. And remember, that's different than DMC, who used corn, alfalfa, and soybean meal and had fixed amounts. The second difference is the milk. LGM uses the class 3 milk futures, which is different than DMC, who uses the all milk price. And so we got difference in feed costs and we got difference in price, but still the same goal is to protect the margin. And the premium is subsidized. Talking with Kenny Burdine, who's at University of Kentucky, he's done some research in LGM, and so what he's shown is that it can be used, if used correctly, it can be used effectively. And then the offerings run with the market is another difference. Since we're using futures, it's more fluid and flexible with the market, whereas DMC is flat and kind of fixed. And so we got differences in the nature of the program. The first thing I want to talk about is the difference in price. As we talked about, one is using the US all milk, one is using class 3. Historically, it's always been a rule of thumb that the US all milk is higher by $1.50 per hundredweight. It's kind of the rule of thumb between the two programs. But if we look back to last year, we can see that there was obviously some big dramatic swings in the difference between all milk and class 3. But as we've gotten into 2021, we're holding much more close to what we've seen historically. So while 2020 had a lot of variability and drastic price swings, 2021 looks more to be kind of what we would expect. And so I think it's okay to say, still now it's currently back to that roughly $1.50 per hundredweight difference. But what I wanted to highlight here is that in a year that has a lot of volatility, a lot of uncertainty, and a lot of risk, 2020, look at the pricings that we were seeing. I think that also goes to show why some people increased their participation or went back to using DMC compared to the previous years. So we've talked about milk difference, and we need to talk about the feed cost difference. So the LGM dairy uses the corn and soybean meal, and the producer can match this to their operation and I have milk production, but we know how much milk production we can generate. We kind of know what our feed costs are, and there's min and maxes with these with the prices that are used here. The default, so remember, if the DMC had their default, the default for LGM is 28 pounds corn, 4 pounds of soybean is the default if you were to use the program without adjusting it. If you go to the website and use it, that's a default setting that it's set at. So you can move that up and down. There are mins and maxes associated with those. Again, if we look at DMC, it's more fixed. They use corn, soybean, and alfalfa cash prices. And this is also dependent on Farm Bill. And I put that in there just because, again, I want to highlight that as we move forward, the Farm Bill is going to be critical to DMC. But the default setting, again, what I wanted to show you and highlight is that there's an increased amount of corn for DMC, there's an increased amount of soybean meal for DMC, and there's also alfalfa there that's not in the LGM dairy. And so it's, if we just look at the programs, we're comparing apples and oranges at that point. What I would really want to highlight and kind of show y'all is that if we can adjust for them and make them similar to each other, then we can compare them better, and probably it won't be as confusing for producers whenever they start thinking about the LGM as a way of combating risk. And so we got to adjust for the milk price difference. We got to match our feed, and we got to adjust for alfalfa and basically subtract that out. And how do we do that? First thing we want to do is go in and set the corn and soybean quantities in LGM to match that of the DMC. And although the prices will be different because we're using futures versus national price, what we want to manage is that change in price. If you remember in DMC, the percentage change, it's still the same thought of, or train of thought. It's we want to manage that change in prices. Then we're going to add in the all milk minus class 3 difference. We'll subtract the alfalfa. And so I think I get into it here in the next one. Yeah. And so that's how we want to adjust. So we want to set our feed costs the same. We want to adjust for our milk difference. And then we also want to take out the alfalfa because it's not in there. I'm working with Kenny Burdine, and this is some of the cheat notes or cheat sheet notes that we use to come up with how to make them comparable. If you don't, you're like, Charlie, I don't want to sit there and calculate that. You got some rules of thumbs that you can use? Yes. For the default setting, if you just walk into LGM and you don't really change it at all, and you're like, hey, I don't want to change it, that's fine. But the rule of thumb is that the default margin needs to be at least $4.50 or $5 higher than the DMC one. If you adjust for it, the LGM margin needs to be about $1.50 to $2 higher. Again, the difference is going to kind of come from the alfalfa and stuff of that nature. So if you adjust it, you want to be in that $1.50 to $2. If you don't, roughly $4.50 to $5 is where you want to land. So what I want to highlight is that the key differences are that the LGM dairy uses futures-based. It's futures-based and uses the futures prices. It's available from, it's an insurance program that's available from insurance agents. But what we want to highlight in this situation is that it evolves with the market. If it's bad, it's going to turn bad with it. If it's good, it's going to be good with it. So good times equals good opportunities. The DMC is similar to previous programs. When I say that, if we think back to previous farm bill programs, this one would be seen more as counter-cyclical, which means that if prices go low, we have a floor set, and there's that difference is set, or that difference is a payment to the producer so that they have a set floor. If it's above the margin, then of course there's no payments going to producers. The LGM dairy, I think while I mentioned earlier that it seems like we're trending down in price according to the dairy outlook, and also the feed costs don't look too much in favor of for dairy producers here. The best time to probably use LGM dairy is during profitable times. And keep in mind, we can enroll at any time for LGM. All you got to do is go purchase the insurance program. So what if we did end up making a turn where it's like, hey, profit's going to be there? Maybe that's a way to capitalize. Basically, getting the cake and the icing is how I would kind of look at it. On the DMC side, I think one is not only good to have a baseline or a floor set in our profit margin, but it also presents the opportunity to not go below that floor in challenging times. Again, I want to highlight 2020. It was a year of unknowns, and I don't want to say black swan events, but just events that are not common, and they happened they happened back to back so quick. Just it presented a lot of uncertainty that became reality, and DMC, the folks that were enrolled in DMC, really capitalized on that part. The next thing I want to get into is dairy RP. So we've talked about DMC. We went to another level with LGM, but then this program right here, the Dairy Revenue Protection program, is probably on the same level as AGM in terms of added protection. It's a little bit different because we're not protecting the margin, we're protecting the revenue for the operation. And this is also another program that you can get into whenever you basically want. depending upon time of the month and stuff of that nature, because of how enrollment occurs. So how does this work? The policy will pay if the actual revenue falls below coverage level. Okay, what the heck does that mean, Charlie? It means that the actual revenue, if you have a coverage level and you pick it and your revenue falls, that's when the policy is going to pay you. Similar to DMC, where if you set your price, your margin floor, and it goes below the margin, then you're going to get a payment. And so it's kind of hitting the same thing, where it's all about revenue, margin and profitability, where this is the revenue side of it. So if it falls below a certain level, you get a payment. It's critical to acknowledge that it does not pay for death or a death of dairy cattle, any loss or destruction of your dairy cattle, or any other loss or damage of any kind whatsoever. That comes straight from the government or the program, and any other loss or damage of any kind whatsoever. I guess they're just kind of throwing it out there as a catch-all. But how it works is that it uses a 3-month averages of CME prices, and they're used to estimate on a quarterly price basis. And so it's the weighted base of class 3 and class 4, and its production is based on regional estimates for Tennessee here. In some states it could be by state basis, but for us it's regional. A producer may cover 80% to 95% of their expected quarterly revenue in 5% increments. And so I have the coverage level there in terms of percentage, 80 up to 95, and the premium subsidy associated with those coverage levels. If you have dairy, if you have livestock LRP, this is basically the same type of train of thought there. You just basically protect your revenue. And so I'll give you a quick example. I just put the fourth quarter, but we can put any quarter. Say we want to protect milk in the fourth quarter, our fourth quarter milk revenue. The class 3 is at $17.50. Class 4 is at $18.50. And so we want to put a 50% emphasis on both. So that gives us an average of $18 per hundredweight. Production levels, we say we're at 500,000 pounds per quarter. Where I get that number is that if we have 100 cows, 5,000 pounds per quarter, that's how we get to our total milk production for that quarter. So we know our price and we know our production. So price times quantity gives us our revenue. And so we go, okay, we know our revenue. What kind of coverage do we want? So the opportunities for you there are presented from the 80 to 95% coverage levels. If we remember, 5,000 pounds at 18 per hundred, 5,000 hundredweight times $18 per hundredweight gives us $90,000 for that quarter. We can pick our coverage level. For this example, I just picked the 95% coverage level. That gives us 85,500 coverage level. And again, I want to mention that production is based on the region, but can be scaled up or down. So the understanding the premium associated with that is that they will be that it moves based upon the market expectations and perceived risk levels. It's cheaper for near time periods, so like fourth quarter of 2020 versus the second quarter of 2021, where we can, it's whatever quarter's closer is cheaper because there's less uncertainty, less risk, right? So the further you go out, there's more risk, more uncertainty. Therefore, the price is going to be different. The more coverage you pick, it's cheaper for lower levels. It should be 80%, much cheaper than 95%. I apologize for that. But for this illustration, we lock in 25 cents per hundredweight on a 5,000 hundredweight. That gives us a total premium of $12.50. And so we say, okay, we've locked it in. We've locked in our premium. What happens if price dropped? Just because I put there in case we're trending that way. So let's see what happens. We've guaranteed ourselves 85.5. Remember from the previous example right here on the 95% coverage level. But the final average of the quarter ends up being $15 per hundredweight, which is $3 less than expected. But on a positive side, your production is as expected. And so if we do our 5,000 hundredweight, or 5,000 hundredweight times our $15 per hundredweight, we get $75,000. Therefore, the indemnity is triggered and you receive $10,500. But remember, the gain on the insurance is only going to be $92.50 because we also have to take out the premium that we locked in from whenever we locked in our insurance program. And so hopefully it didn't confuse you too much, but this offers protection on the revenue side that you can also complement with DMC or LGM, or if you just want to do one, that's up to you as a producer. So conclusions, what our key takeaways is that, the programs can now be completely separated. You can do one or the other or multiple, it's fine. At the minimal, I always suggest that you utilize DMC and cover up to 5 million pounds at the $9.50 level if you can. If you go over that, if you're over 5 million pounds, that's, use it. But making the decision on the long-term discount, I think it's going to vary by operation. One, it's the size of the operation is going to matter. How risk the decision manager, whoever's making that decision, how risk adverse or how risk loving they are is going to probably dictate, if they're willing to go ahead and lock it in now, or they're just going to take year by year basis. The 25% discount is not worth, the opportunity to capitalize on more in the near future, for instance. But this is a key risk program for protection against unknown future events. Again, I've highlighted the black swan events, pandemics, could be a yield. If we're, next year and a drought hits and there's not a lot of corn going around, it could be prices increase a lot again, and we're, you're stuck where your margins really getting eaten up with high dairy or high feed costs. Could be the same thing for prices again. So I think from that standpoint, DMC is really a good, minimal program to be used. I think if you're not using Dairy RP or LGM, I would consider that. They both have risk reduction potential. And I went and pulled the numbers for Dairy RP policies that have been sold. And again, with kind of a trend that coincides with DMC. In 2019, there was 20 policies sold. 16 of those policies earned a premium. And this is how many pounds was insured through those programs or through those policies. We went down in 2020. 10 of those still, earned premium. And that's how many pounds was insured. While our pounds have decreased in 2021, we actually increased the policy. The policy sold increased, similar to DMC. If you remember, 2019, we had more in 2019 than we did in 2020, but then we ramped back up in 2021. And just to see what was happening in the future, there's already been 22 policies sold for the 2022 year. And so that's, right now that's currently second most in the last 4 years. But as you can tell, policies earning a premium. Last year it was only basically 5 out of 25. But I don't know the coverage level of those. I don't know what percent was picked. So maybe that's a reason why on that side, on the Dairy RP side. In the last 2 years, a big fat goose egg is what's been sold on the policy side for LGM, but we've had none in the last 2 years. I know in the surrounding states, there's been 4 in one state and 1 in another state that neighbors us. So this program, while LGM does have its benefits, it seems that it's nobody's really using it, and maybe that's a function of kind of the confusing nature of it and kind of how do you utilize that program if it's confusing, and I understand that. But if you are interested in using LGM, dairy, or Dairy RP and you want more information, I'd be more than happy to answer your questions about it or send you an email, or maybe we could sit down and chat and talk about the programs and see if it would be worth something to help you in your risk management. Again, it's going to be different upon your trigger points, your coverage levels, the insurance agent, you got transaction costs and stuff of that nature. But thanks for listening. I hope I didn't take up too much time. Usually I'm out by 30 minutes, so I'm 10 minutes over my own time. But there's my Twitter handle, my email if you need to get a hold of me. If there's any questions, Liz, I'll answer them.
I don't see any yet in the chat. And Charlie, you sure that through all this complicated stuff really fast?
I didn't even
cutting
mention
your time in half.
Didn't even mention futures and options, because that's another risk management tool for another day.
I mean, you still had 20 minutes.
Oh no, it's hard to retain all that.
Yeah, that would be a little bit much. Anybody have any questions for Charlie on any of these programs, or maybe locations to go to get at some of this stuff? I know most of it's through FSA offices, correct?
RMA and FSA
Okay.
for RP and LGM. You can just go to insurance. You can go type in RMA, go to those, and you can find insurance providers. FSA is DMC.
Okay.
And open enrollment, they have not signaled exact date. They keep saying fall of 2021. We're not very far from fall of 2021 by my definition. I mean, the trees are starting to change a little bit. So I think behind the scenes might be a function of if they're going to extend the farm bill, how long they're going to extend it for. I think that's part of the function. And then the other part is, of course, with there's going to be supposedly more assistance for dairy producers. And how do they balance all those pots of money between DMC? Because there's also talk about changing, the federal marketing orders and stuff of that. All that good fun price debate. There's talks about that. So I think there's a lot of things moving behind the scenes that hasn't allowed for an exact date to be established for DMC this fall.
I'm still not seeing anything in the chat. Nobody's unmuting to ask a question. I am going to throw the link to the post-completion survey in here again real quick in case anybody missed it earlier. And for anybody who can't see the chat, it is https://tiny.utk.edu/ww2021. So the same way you got into the meeting, that's how you're going to get to the link. And tell us what you liked, what you hated, and if y'all need Master Dairy credit, that serves as your sign-in sheet for the day. Before y'all pop off, Charlie, do you want to talk a little bit about our meetings in a couple weeks? I can share the flyer.
Yeah, go ahead.
Gotta remember how to share. It's been a while since I've, actually shared things on one of these meetings.
It's done. We had a bunch of Zoom meetings, and the computer decided it was going to run the show and did not want to work. And I was like, Zoom for how long? And it acts like it doesn't want to do it.
Exactly.
So I know it's titled Dairy Margin Coverage, but basically it's going to be more about risk management talk at that point as we go through our little road show. By the point of this kicking off, and by September 20, we should already have the new Dairy Outlook report from last month or from this month. So might adjust it and say, hey, maybe LGM is going to be more favorable. And maybe that's another reason, I didn't mention it, but maybe that's another reason why we haven't had so much participation in LGM, just because if it's good during profitable times, right now, last couple of years has been kind of not so fun without government payments. So maybe that's another reason why LGM has not been employed yet or as much. But yeah, you can see the dates, the ones that there with Zoom sessions available, be putting a lot of miles in.
Yep, we're going to be tearing up the road, but we are looking forward to getting out there and seeing some of you in person again. We will be monitoring COVID-19. If anything happens, we will move to a virtual option or delay, but we will make sure we talk with all of you about that. There is a registration link. We would ask all of y'all to register first so we can get a good head count and figure out how many people we're feeding. Yes, we're going to have lunch and dinner, so now you really have a good reason to come. I'm throwing that link into the chat as well, but we look forward to seeing you. And any of our people that are joining from Kentucky or North Carolina will be in Campbellsville and Glasgow on the 23rd, and we'll be in Statesville, North Carolina on the 29th. And we'll also be talking a little bit about our Dairy Gauge program.
Yeah, that's what I was going to mention.
Yep. Do you want to talk about that too, Charlie?
Yeah. So I've mentioned the Dairy Gauge program today, and kind of what we saw in last 2020 and 2021. When I say we, David Bilderback, the folks from KDDC, and then North Carolina State, we're seeing kind of the impact of government payments and all that stuff. So what we want to do is also present what happened last year financially for some of our producers, and that'll include Kentucky, North Carolina, and Tennessee producers. And what we'll have is some benchmarks that are the average of the group, and you can it's not gonna be anybody's information up there, but just more of what we've seen, where there's some stress levels in the benchmarks for our producers, and kind of talk about moving forward, some things that we could do to better those benchmarks. And then, like I said, without the government payments, and I heard David Bilderbeck say it last year, although we won't, we'll never see the government payments at this level again. And then we got more so this year. So, it's keep in mind, and, we'll talk about some stuff and the importance of risk management and government programming.
All right, y'all. Well, I won't keep you overtime just to keep you overtime. But if you are interested in those meetings, please, please, please do register. We hope to see you in a couple weeks. And again, let us know how mostly Charlie did. I'm just on here for fun little quips at the beginning and the end. And we'll get this recording posted later. And Charlie's going to send me those slides and I'll send those out with the recording. So thanks everybody for joining us.